Behind the Markets is also live on Sirius XM 132. So we have a show every Friday at noon Eastern. And so here we're doing a special episode of Behind the Markets live from the Future Proof Festival. Great conference, great time. Really a way to do these conferences. And JC, Matt, thanks for joining me here on stage for Behind the Markets.
Thank you, yeah.
It's great.
We're going to have a real interesting conversation. So with JC, we're going to talk a little bit about the market setup, what's happening now, how he thinks about the markets, and then we're going to go into how to implement things with Halo Investing and their structured node platform. There's going to be some interesting, I think, breaking news today on collaboration between WisdomTree and Halo. So we're going to talk a little bit about that, but also on how to use structured nodes in a model. But JC, looking at the charts, give us your background on how you think about technical analysis informing you where we are and how you approach the markets.
Sure. Well, this is great. Thanks, guys. Fantastic. Huntington Beach is beautiful. So when we approach the market, when we look back at history, one thing that we know for a fact is that asset prices trend, right? We know that. You can go back and you can see stocks going up for a while, they go sideways for a while, they go down for a while, but we know they trend, right? There's a zillion white papers. I'm sure Nick could point you to them for those of you who read white papers, but there's plenty of them. So if we know that, then we're going to spend the majority of our time looking for trends. And it doesn't necessarily mean that they're uptrends. They could be sideways trends. They could be downtrends as well. And we know that for a fact. So we're going to try to use that wisdom to our see what I did there? To our advantage as best as possible. So, and when we talk about trends, it's not just at the index level, like the S&P 500 or the Dow or the NASDAQ 100, but the components that make up those indexes, and understanding what stocks and sectors are driving those particular indexes and the differences between them. The NASDAQ 100 composition is going to be very different than the New York Stock Exchange Composite or the Russell 2000, right? So it's a market of stocks. And when we look at the market of stocks, the new 52-week lows list peaked in the summer of 2022. So in other words, as bad as things were, the worst things was last summer, June in particular. And you can even argue that we were already seeing some strength underneath the surface earlier in Q2 last year, but it really was as bad as it got. And then from there, things just got progressively better. In the back half of last year, the leading sectors off the lows were things like industrials, consumer discretionary was doing well, and even financials were doing pretty well. It was really those growth areas, technology, that wasn't participating in that rally, particularly the mega cap growth. And then the market got that rotation at the beginning of the year. And sector rotation is the lifeblood of a bull market. That's what should have happened in a strong market environment. And historically speaking, going into a pre-election year, around midterms, you buy stocks. It's the sweet spot. Best time ever to own stocks. And what do you know? Stocks did great, right? The NASDAQ got started off to the best first 6 months of the year ever during a time where it should have done well. So the market was acting perfectly normal. And then heading into Q3 of those pre-election years, we tend to see the market struggle some, churn some. Stock Traders Almanac here, Jeff Hirsch, shout out, right? The best in the business. And he'll tell you, this is perfectly normal market behavior. In fact, if the market wasn't behaving like this, that would actually be very unusual. So the market is just consolidating gains. And then when you look at, I'll pass the mic, but when you look at what's driving these indexes, you look at technology as a sector index, it's back to the 2021 highs. And now we're failing here again. Semiconductors, back to the 2021 highs. And we're failing here again. Industrials, same thing. Home builders, same thing. These are very, very important sectors and industry groups for this market, and we're literally back to the prior cycle's peak from the end of 2021. So the most important areas are stuck below overhead supply during a time of the year where markets should struggle, and that's exactly what's happening. And I think that we should probably get pretty comfortable with this because I don't think it's going to end anytime soon at the index level. But I continue to think that there are going to be stocks and particularly industry groups that can do very, very well in this environment despite the indexes kind of just churning sideways and frustrating both the longs and shorts. You look at things. Look at oil. We're recording. What day is it today?
September 12th.
September 12th, and oil is pushing $90. These energy stocks have been outperforming for quite some time. They don't care what semiconductors are doing. They're going to do their own thing. So, and I think there are other areas, like in materials and things like that, that have very low or no weighting at all in these indexes, and these stocks are ripping. So I hate to say it's a stock picker's market, right? Just punch me in the face whenever I say that. But if there was ever one of those, this is kind of it, right?
So let's talk about this presidential cycle, because this is a very strange political season. Maybe one of the stranger election seasons we've seen. How do you think it plays out next year? All the headlines back and forth in terms of where we're going.
Yeah, I mean, listen, I don't know much about politics, but all these elections seem pretty strange to me. So, again, it's not perfect. Nothing is. But from a seasonality standpoint, and not just the 4-year presidential cycle, but just throughout the year, as humans, we behave in different ways in different times of the year. We hang out with different people. We wear different clothes. We go to different places, right? Whether it's the holidays or the summer, it's just different. And if you think that those changes in our behaviors are not impacting the decisions that we're making in the market, I guess you don't know humans, right? We're going to behave in similar ways. And it's not like, oh, sell in May and go away, sell everything. No. For me, the bigger signal is when the market ignores seasonal tendencies, right? So the fact that the market ripped, S&Ps were up 7.5% in the fourth quarter last year, up another 7% or so in the first quarter this year, another 8 or so % in the second quarter. In bear markets, stocks don't go up every quarter, first of all. Second of all, that's perfectly normal. Markets should have done well. And now we're supposed to struggle historically and then rip into the end of the year, holidays, November, December. Best 3-month period of the year is that November through January sweet spot. Look at me. Come on, Jeff Hirsch, right? Look at this guy. Come on. I'm here regurgitating all the things that I've learned from Jeff over the years, but it's so true. So if the market, for example, let's say the market would be strong right now and not struggling at the index level, that would be a signal. That would be evidence of strength despite a seasonally weak time. But the indexes aren't doing well. They're struggling like they should, so no signal. So if they don't rip into the holidays and rip into the beginning of the year and are actually falling and making new lows, that would be very worrisome for the overall market. That would be the market ignoring that seasonal strength.
What do you think about the bond stock correlation? So last year, bonds and stocks were majorly down together. We've got rates creeping back higher right now. Is that going to affect the tech stocks? Should it affect the tech stocks in your intermarket analysis?
Yeah, probably. There's great data out there. Jim Bianco, shout out Jim Bianco, puts out great data going back to, he's speaking of Chicago, going back to 40s and 50s, and the correlation between stocks and bonds tends to be lean positive when inflation is the concern in the market, and turns negative when deflation is the concern. So we've seen that negative correlation for quite some time now because the overall worry was the deflation. But when you're in an inflationary cycle, that relationship flips, as we've seen. Rather than the defensive vehicle that bonds have been for the majority of at least my career, right? Last year, when bonds were selling off even harder, right? Because bonds were getting crushed, interest rates are ripping, so anything long duration, anything technology growth, things that aren't going to earn any money for a long time are getting slaughtered, right? So that correlation between stocks and bonds is much more positive than it has ever been in my career. But when you go back to other periods where inflation was the concern, you saw similar behavior.
But now we also had a period where bonds were crazily priced. So you had TIPS yields at negative 1.5%. So there was no real compensation. I mean, it's a different story when the 10-year TIPS is 2%, when the 10-year TIPS is 1.5 negative. So I think it'll be interesting. Is the compensation for bonds becoming like the insurance risk asset of choice? Like there was a premium you paid for bonds because it was this insurance asset, but it lost that when you're giving the government 1.5% a year after inflation. So I think it's going to come back as a hedge, but this question of the correlation is definitely an interesting question.
Yeah, I mean, I'm not big on hedging You know, if you like something, own it. If you don't own it. You know, for most investors, a lot of investors don't have to, you know, worry too much about hedging. Like if, you know, like I look at the long-only fund community, right? A lot of assets there. And the big question that we've been asking ourselves, and that's the whole thing. It's not that technical analysis gives us all the answers, but technical analysis and understanding market trends really goes a long way in helping us ask the right questions. So I think this question right here, where we haven't seen a defensive rotation in the equities market into consumer staples, right, into the low volatility stocks that you tend to see when there is a flight to safety and money is coming out of equities. You tend to see that outperformance out of low volatility in consumer staples. We haven't seen it. So the argument is that money's going into bills. It doesn't need to go into staples. I don't necessarily buy that. I don't think so. I guess we'll see, but I look at the lack of rotation into those defensive sectors as further evidence that this is just a consolidation at the index level that will ultimately break out versus the beginning of something bigger, right? Every big move starts with a little move, but not every little move turns into a big one. So the question is this the big one, you know? I haven't seen any evidence of that. I haven't seen it in credit spreads either. Look at high yields, credit spreads as tight as they've been all year. So you're not seeing that traditional defensive rotation. And then the pushback, fine, is that, well, JC, none of those things had bills paying all this. All right, I guess we'll see. I don't think so.
Matt, we're going to bring you in for a lot more conversation in the second half, but just to, what is your thoughts on all you've heard from JC so far about the current market dynamics, what you're seeing from some of your clients on the Halo platform?
Yeah, no, fascinating and fabulous comments there. And I think from our perspective at Halo, right, I think it's really interesting, right? You talk about the trends, which are undeniable, right? And that's followed down by the irrationality, right, of many of the investors. And I know as advisors, many of you out there in the audience today, you deal with this on a day-to-day basis, right? And so, you know, I'm not up here to debate right or wrong, but I would like just to highlight the fact that it's complicated, right? Because there is a timing to all this. And so, to me, it speaks to the opportunity to make sure that, you know, tool sets are in place to make sure individuals are in the market, right, aligned with their goals, they stay invested, right, and quite frankly, to you know, I'll say immunize them a little bit, right, from just the timing of these trends and when and how they ultimately end up affecting the end investor in their portfolio. Right, it's super complicated, right, and you know, again, it's one of those things where I'm sure each and every one of these individuals in the audience here has a perspective, maybe aligned, maybe slightly different, and so, you know, I think for us, it's really about, you know, empowering you know, advisors and clients with the tools they need to capitalize, right, appropriately on those trends, manage risks where they can, but most importantly, you know, get invested and stay invested.
I will say I'm happy with our turnout at 8 a.m. So shout to the audience for coming up this early in the morning after a good late night.
They came to see you, Jeremy.
Of course. JC, let's come back to one of the things you've been writing about that I retweet all the time, is the stuff on the dollar versus the S&P. And you talk about how, you mentioned not wanting to hedge, just like things when you like them, but how does the dollar come into your view for the S&P? Because it's something I do in my research as well, but talk about how you think there's an interrelation between the dollar and the S&P.
I mean, that's been the signal. If you ignore everything else on this planet and you just watch the dollar and you did what the opposite of what the dollar was doing in the equities market, you'd be doing great. That's all you needed. That's all you needed. When the dollar's been going up, stocks are under pressure. When the dollar goes down, stocks rip. That's it. You know, and correlation was like, well, JC, in the 90s, it wasn't like that. Well, it ain't the 90s. It's 2023. I get it. In the 90s, it was not like that. Things were very different in the 90s, right? The dollar has, as it turns out, was the only safe haven all along. Last year, equities are getting slaughtered in the first half. What happened to bonds? Slaughtered even more. Japanese yen, traditionally, that yen carry trade, you're going to get a bid when fear comes in the market. Yen was making 20-year lows. The yen wasn't a safe haven either. Gold sucks as usual. No, you know, what else is new? Definitely nothing safe there. And what did do well?
The dollar.
The dollar. Dollar was absolutely ripping. And then a funny thing happened in October, right? You got the, what was it? The Barons, was it Barons, right? With George Washington in a tank top, flexing his muscles, jumping out of a dollar bill. That was it. And then Bloomberg comes out, shout out Bloomberg, can't stop, won't stop on the US dollar, like with these neon lights, like all psychedelic. The dollar had already peaked the week before. It takes time to get all of the cover art approved and whatnot. So the dollar had actually already peaked. And then what happened? Stocks absolutely ripped with the weaker dollar. And then once the dollar stopped falling, stocks stopped going up, right? The dollar bottomed, check my math, I believe it was July the 12th, July the 13th. That was the day the new 52-week highs list peaked. That was 2 months ago. People are like, oh, we're not in a correction because it hasn't fallen 10%. Are you out of your mind? We've been correcting for 2 months. We're in a correction, right? They happen. It's a thing.
It's interesting. I mean, I did, lining up these sort of technical moves with the fundamentals, I did a piece a few months ago talking about the surprise impact on earnings. When I did a look at the last 60 years of earnings, when the dollar was rising, earnings growth, so I'm looking at the last 6 months of the dollar's change and then the next 6 months of earnings. So when the dollar was rising, the average 6 month forward earnings growth was literally 0. And then when the dollar was falling, the average 6 months earnings growth was almost 7%. So it was like a 600 basis point spread. And that was for 60 years. The last 30, half of the period, last 30 years, it was like a 900 basis point spread. So there was a smaller dollar move and a bigger impact on earnings. And it goes to your point, hey, we're becoming more multinational, more of our earnings coming abroad. I do think there's a real fundamental driver there in addition to anything else going on.
Yeah, I mean, maybe. Sounds good. But I don't know. I don't know. Maybe, right? I believe you. But for me, the bigger thing is, the dollar, there's no other safe haven. You're not seeing it.
Yeah.
Right? You're seeing it in high yield credit when there's a real flight to safety. That's still there. If there's stress in the market, you're going to see it in credit. We're not seeing any stress in credit, by the way, right now. And you're still getting that flight to staples and low volatility stocks. We're not getting that right now. I think that's information. It's the dollar. So for me, when you look at the dollar and you look at rates, it's very simple. The rates situation, in my opinion, does not determine the risk on or risk off as much as the dollar. For me, the rates situation is more of a sector rotation. So if rates are rising, you're going to get that outperformance out of the more value-oriented areas. You're seeing it in energy, financials, healthcare, certain parts of healthcare anyway. Look at materials. Berkshire Hathaway keeps going up, right? Like these are value-oriented areas that are going to outperform in a rising rate environment. In a rising rate environment, the growth stocks historically do terrible, right? And they're under pressure with interest rates rising. So for me, that's the interest rate story. Which sectors are going to outperform? The risk on, risk off is the dollar. If the dollar's rallying, stocks in general are going to be under pressure. There's no question until proven otherwise. And all the market keeps doing is proving that that's right. Anybody who's fought that has lost.
Now, you mentioned gold has not been a great place to be defensive. Now, I would say, like, with all the move in rates, you might think gold should be much, much lower, given how rates are doing. But let's go to commodities generally. You mentioned that there's some rotation in energy right now. What's the long-term trend on commodities versus the S&P, say, and how long do these trends last, in your view?
You're just throwing me alley-oops today, Jeremy.
Yeah, I'm following his Twitter feed. It's all stuff straight from his Twitter feed.
Somebody's reading my stuff, right? Somebody reads this stuff. Listen, I will say that the fact that real yields have held up so well and gold's not getting crushed, like gold's not going up, but you would think it'd be struggling a lot more. So I'll give you that one. As far as the trend in commodities, I almost treat gold like a currency. It's almost like not a commodity, right? It's like its own thing. When I think commodities, I think base metals, energy, things like that. And trends historically between stocks and commodities, when commodities are leaders and commodities are in favor and they're in a secular bull market, these trends don't just last a couple of years. They never have. They always last a decade, at least. So this one started in 2020, beautifully timed with crude oil literally trading below zero. Talk about like an epic end to a secular bear market in commodities that lasted about a decade or so, right? And crude oil traded below zero. Then you got that initial ripper where everything energy just ripped off the lows. You had that digestion, that consolidation, and now it looks like we're resuming this trend. And if we're 3 years into this trend, we're maybe a third of the way there. So I think we have a long way to go. I don't know how high oil's gonna go. I have no idea. My suspicion is higher. But when I say oil 250, people laugh. People laugh. And maybe oil never gets to 250. I have no idea. But as investors and a lot of financial advisors that deal with people's money and our own money and everything like that, I think we just need to keep in mind that that's on the table. Like we can't just say 250 never gonna happen. Maybe it never happens. But as investors, I think it's irresponsible to just completely take that off the table. I think it's entirely possible. And again, whether we get there or not is not the point. Just keep that in the back of your mind.
Well, and you say you don't love hedging, you just like things that are going up. But oil and energy does seem, if inflation is the new concern and bonds aren't acting as the hedge that they used to, energy and commodities and oil offer a different hedge than they used to in the deflationary period in the falling commodity prices.
Yeah, it's like when I buy Instacart, because my wife spends so much money on the Instacart, it's like that. I'm hedging that situation.
For sure.
Yeah. So oil, same thing. You're flying around, you're driving around, if you own it, sure.
What do you think? So we talked a little bit about rates. The banks are one of the key questions, the regional banks. I still worry about the underlying drivers that they're not paying you the appropriate 5% rates on your money that you could be getting in treasuries. To me, they have a challenging profit dynamic looking ahead. But what do you see in the charts?
There's probably way too many regional banks. We had a few of them disappear that no one's really ever heard of. Remember, everybody was freaking out, like in the spring, banking crisis. I'm like, who? I've never, Pacific West? I lived in the Pacific. I never heard of this bank, So like, I remember one of these banks was like $1 billion at the time. I think it was like First Republic or something, and it disappeared. I'm like, it's $1 billion bank. It's gone today. Microsoft that day was up like 150 billion or something like that the same day. I'm like, we're sitting here talking about $1 billion bank. This company over here is up 150 billion today, So I think it's really about putting things in perspective. And when you look at European banks don't look terrible. European banks. Remember those?
Yeah.
Usually, like when things look terrible, they look the worst, right? Credit Suisse gone, nobody cares. Most of us were surprised it was still even around, right? Some of these like that Zurich insurance company, some of these European stuff. Look at Indian financials as well. So like, you fundamental guys can tell me, my fundamental friends tell me that they're the most expensive. The Indian banks, like on a multiple or whatever. But, they look, just the price action alone. I mean, so there's some underlying strength underneath the surface that I think is getting ignored because of these little banks. But at the high end level, look at Berkshire Hathaway. It's the largest component of the U.S. Financials Index.
So coming back to just wrapping up the big picture view, we're stuck below overhead supply on some of the key areas, and those key areas you think are semis, home builders, tech.
Yep, industrials.
And until you break out, it could be a challenging dynamic.
Sideways for longer. So the types of strategies that worked in the first half of the year are very different than the types of strategies that are working now. So we're putting on different types of trades. So like in the first half of the year, we weren't selling options at all because you weren't getting paid to. Volatility was super low. Stocks were trending higher. So just pick your favorite stock and buy a call option as far out as you can go. Easy, right? Keep it simple. In this environment, it's not like that. We're in a sideways range. So you're getting paid handsomely to sell premium, right? The buyers want to buy calls because they're super bullish, give them to them. The sellers, everybody thinks they're going to go down and crash. They're buying puts, selling the puts too. Just make it rain, calls and puts all day long, right? And that's a strategy that's working very well now that we weren't implementing in the first half because there's a time and a place for everything. And one thing I learned from Jeff DeGraff, in my opinion, one of the top technicians of all time, one of my favorites, taught me very early in my career that the first thing we want to do is identify what type of market environment are we in, and then decide which tools and strategies are best for that market. Versus the mistake most investors make is that this is my strategy. When this line crosses that one, I buy it, and then no. There's a time and a place. One day, gold's not going to suck. One day, interest rates are going to go down again. One day, the market's going to lose 20% in a month. There's a time, volatility. We are in a relatively low volatility environment historically, but we are higher volatility than we were, right? So everything's relative to where we were and adjusting accordingly. And the market's always changing, and if we don't adapt to the market environment, we're going to struggle. And you guys literally creating vehicles to express virtually any thesis in the market is a great value. Oh, I don't trade options. Okay, you don't trade options, but in certain market environments, options are a really good tool. Right?
That was a great pivot to Matt's part of the conversation here.
See
so
how
Matt,
I did that?
look at
right?
beautiful,
Well
beautiful
done. Great
transition.
segue.
So Matt, tell us more about Halo. Tell us about the platform, what you guys do, what are the vehicles that we're talking about. If we're talking about these structured notes, tell us a little bit more about what those are.
Yeah, for sure. And JC, great intro. I definitely level set. I think understanding the macro view, the complexities of it, right? Just how long-term trends play out, but they're short-term, right? But again, I would double down on just the behavior, right? The behavioral aspect of all this in terms of getting investors to do the right thing at the right time. I think is hugely important. And so, taking a quick step back, Halo Investing is a financial technology marketplace for advisors to purchase structured notes on behalf of their clients. And so you can come to the platform. We have about 30 issuing banks that are available. You can really, as you mentioned, you can design the note with index underliers, ETF, individual security underliers, and really, basically, with two key elements in mind. Do you want growth or do you want income associated with that underlier? And so, regardless of the thesis, right? You can come build, design, implement that strategy and structure. The structured note, I'm guessing many are very familiar, but in its simplest form, right, is a zero coupon corporate bond with a derivative basket attached to it. All right, you pick your underlier. That again can be an index, it can be an ETF, individual security. Set your upside participation, your downside risk. Have it calculate income in the form of a coupon based on some duration that you set.
You mentioned there's these different types of notes. There's growth notes, there's income notes. With rates now 5.5% in treasuries, are you seeing more interest in the growth note side of the business as sort of downside protection, or are people still doing income notes? What's the appetite?
Yeah, and again, that does speak to the flexibility as well. I think we saw 21, 22, into early 2022, income notes were the rage, right? Yields were super high in these notes. Still strong participation on the income side, but what we saw, right, is that as interest rates shifted and higher, there was more interest in the growth note, which again allows you to participate in the upside of that underlier, typically an equity underlier, but also have some downside risk mitigation to it as well. And so it allows you to, again, get into the market, right? If you see that trend, but you're not quite sure on the timing, if you have a client that is, has some trepidation, whether they're in the market or they're trying to figure out when to get in, those growth notes became much more popular, right? Just in terms of allowing individuals to become participants, right, which is obviously key, but still seeing a healthy balance, but again, a strong uptick in growth notes here over the last 12 months.
If you had to put a percentage, is there a rough percentage?
Rough percentage, it's probably right now, I'd say still at about half and half.
Half and half?
Yeah, yep.
If you think about the challenges of structured notes in the traditional bank, let's say you're at a big wirehouse platform and you're dealing with sort of that bank's structured notes. Yep. What would you say the perception of notes are and how you try to address any of the key challenges that people have with that market?
Yeah, for sure. And I think as a market, that's something we need to take head on, right? And I think some of the key challenges just in terms of adoption is, there certainly is, I'll just say, a perceived complexity, right, with anything that has that derivative component to it. But back in the old days, you literally, if you wanted to price up a note, you'd pick up the phone and you'd call the issuing bank and you'd call 5, 6, 7 of them trying to get a quote, trying to get the best quote, right? And you really didn't even understand by the time you got to the 6th, was the first one still good, right? Just in terms of that process and infrastructure. And so hard to, again, get quality pricing, really not as competitive, right? You are going to a bank asking for a price. In addition to that, it's a bond portfolio, right? There's life cycle to it, but there's more complexities just around breaches that can happen at protection levels, callability of the notes themselves, and so there was life cycle management was a key element as well, just added to the complexity, and so many very sophisticated Excel spreadsheets I'm sure still exist out there to manage the life cycle of these things, and so again, really just the trying to get a good price, life cycle management, just the opacity of them, right?
The transparency, the fees.
You got it. Yep. And so really the whole idea of Halo and other structured note platforms was to really, I hate using that word democratize. I was gonna try and stay away from it, but there's really basically create an infrastructure and system whereby you as an advisor now, right, can you take control of that process. Right, you go out, you design the structure, you bid that out, right? So in a blind auction, you can go out to all the issuers we have on the platform. You can select if you have certain credits, right, or certain banks that you have more confidence in. You can pick those banks. It's a blind auction. They come back with their best price, right? Whether it's a participation rate on an underlier or the yield in an income note, basically you're forcing them, right, to compete, which again makes the market as a whole more efficient, and I feel better for the investor, which is absolutely imperative to broader adoption.
How big is that market right now?
So issuance in the U.S. in 2023 will be about $100 billion in issuance, and I'll be honest.
New issuance this year?
In issuance this year, yeah.
Wow.
$100 billion. But honestly, you think about that, relative to the capital markets, still incredibly small.
Yeah.
Usage of these products ex-U.S. is significantly higher. Europe, it's 4x, Asia, even a bit more. And it's really, quite honestly, if you think about it, the only product in the market that has that same phenomenon, right, where there's less adoption in the U.S. than broader. And so, so we got into this business, quite frankly, mission of the firm is to protect the world's investments. We want to take that $100 billion market and obviously expand it significantly, but very appropriately, right?
And what is the total assets now, you think?
Total assets,
globally.
I think in terms of total issuance outstanding right now in the U.S., I think it's about 2.5. Is that right? 2.5 trillion.
Wow.
In outstanding. No, that's 2.5 trillion globally in outstanding issuance today.
Wow.
Right. So there's
and
a
those
maturity,
mature,
right?
they mature every few years.
Yeah,
So
but that's globally.
A lot.
U.S. it's probably a fraction of that.
Sure.
So yeah.
And your target market for users of Halo is the RIA community?
So yeah, RIA community, but it really, again, any advisor that is working with a client that, again, wants to ensure that clients get invested, stay invested. And so we started, our focus was in the independent RIA channel. Again, I think, great tool to be used when building and managing portfolios. And so many of them came out of wires, right? Breakaways that were used to the structure itself, but we're looking for better infrastructure that they now no longer had when they moved into that independent space. And so started with them, and that quickly expands into RIAs that became affiliated with those note users, beginning to spread the word. But I would say, this year so far, half of the advisors that are using notes on our platform had never used a note before. And so education, field engagement is critically important, right, to make sure they're used, again, the right way.
I mean, I see in the ETF market, which I operate in on a daily basis, like one of the, in terms of the top inflows towards ETFs is these option-oriented, covered call type strategies, these buffer protection type strategies. Yep. There's been a lot of interest in trying to take some of the quote-unquote pain off of owning the markets if it's viewed as, well, there's more risk.
Absolutely, yeah. So you're seeing the buffered ETFs, which again is another vehicle that we do a lot of work just in terms of helping advisors evaluate and recommend. That's more of a perpetual product, right? And so with that, you do have to give up a little bit of the flexibility just in terms of honing in that specific note to your specific client. But we're actually excited about the growing interest in those. Again, I think good product on the protective investment side, but I also do think it'll encourage more advisors that may be interested in those to take a look at the notes and what they might be able to offer as well.
So one of the things I mentioned at the top of the show, we're going to have some breaking news about WisdomTree and Halo collaborating. So we do have sort of an announcement. We talk a little bit about, we're working on a joint model. So you have a model marketplace that you've developed where people have been buying individual notes that they would have to then go customize their terms. They could put it out to auction and get the bids from all these different banks. But you're trying to provide a more cohesive solution, sort of model portfolios, not have a single S&P 500 or NASDAQ or whatever, but actually have a full global type asset allocation solution. You've got a few model providers. We're going to be one of them now on the platform. Talk a little bit about your goals with this model market center and how you're thinking about going from a single note towards a portfolio of notes.
Yeah, no, absolutely, and super excited, and you're really appreciative of the partnership here. And so, as Jeremy mentioned, we are launching a note SMA portfolio with WisdomTree. Taking a big step back, I spent a lot of my career at Ibbotson Associates, Wilshire, and most recently at Morningstar, all with a focus on helping advisors build better portfolio solutions for their end clients. You're really focusing on that end investor and the goals and the outcomes that they really seek. And so, don't want to give too much of the biography or autobiography, whatever you might say, but joined Halo. You got interested in the mousetrap, right? The note. I'd built glide paths, I'd built diversified model portfolios, and helped drive them through advisor adoption, and really came to appreciate the structure itself, right? And in addition to that, again, had always been very interested in trying to help advisors scale their practice in a way that, again, aligns with their investment philosophy, their investment approach, but leveraging third-party expertise, right? Whether it was our own or other third parties like WisdomTree and other model providers. And so when I got to Halo, just realized there's an incredible intersection that's available, right? And so in terms of model adoption, adoption of ETF or mutual fund-based model portfolios or other SMA strategies, again, that point of entry issue becomes very difficult, right? How do you get the investor to transition from where they are today into the market? And so with that, we've decided that building note-based SMAs is a great way to bolt on, right, to that core portfolio allocation. And so, really, what does that mean, right? And so we partner up with investment experts, in this case, WisdomTree, right, to provide their guidance, right, just around asset allocation policy, current market conditions, right? Where are we, right, in the midst of those trends, and identify key elements of growth, right? How should we be allocating to certain asset classes in the market, but with downside protection, or where are there opportunities for income, right? So to translate that equity exposure into a secured income stream. And so, again, typically as an advisor, you would have to go into our platform and decide which underliers do I want to choose, what durations, how do I want to set protection levels. And the SMA does all of that for you, right? In partnership with WisdomTree, we build a portfolio of those notes, and we manage that portfolio of notes ongoing for you as an advisor. So you get the exposure to those notes and all that they can offer, but the life cycle is fully managed, again, for you as a trusted partner and outside expert.
In the infrastructure, for us, we've been seeing that trend in ETF world, where model portfolios is something we've been doing a lot more with, putting models on the major platforms, building our own implementation, through adhesion and some other sort of customizable models. And this is, to me, it's an exciting new asset class of bringing the structured notes in a package, that you're not just having to buy a single one, you get the full view.
Absolutely, right? And it comes down to, right, defining the outcome. I think all of you out there in the audience that are advisors spend a lot of time working with individual clients to lay out the plan, right? And I totally agree with your comment earlier, right? You can't just buy the strategy and say, you just keep on pressing ahead. And again, that's where we think that attaching that SMA that aligns in this case with the model is a really good way to, again, voice more of your near-term view, right, on where you see the market going. But again, maintain, though, that core, right? It allows you to create a baseline, let's call it, right, strategy and allocation. But again, get that individual that may trust and love the plan, but comes back with I'm just not sure if the timing's right. Like, where are we in these cycles? it allows you to, again, get them to participate into the market when they might not, right? And then
I think it's a great complement to a lot of other things that we do as investors.
Absolutely. That is so key, and I will say that, right? It is not the sledgehammer to every
I'm not getting
nail.
paid for this, by the way.
Yeah,
it's true, though.
Yeah, just met JC today, so yeah, appreciate that. No, and I agree with you, and I do think that's actually hugely important, right, in terms of usage and adoption, and not to go back to your points around some of the challenges, earlier in their use. But again, it's not a sledgehammer to every nail. It's a great complement. It's another tool in the toolkit. Again, with the focus on driving towards a defined outcome, right, that should be attached to some goals that individual has laid out. But again, just another tool in the toolkit to get them in the market. And then as importantly, right, give them the confidence that once they're in, right, that protection, right, or that income stream that they have, will again, allow them to stay invested comfortably.
I come back to thinking where we are in the market dynamic and coming back to where are expected returns? We sort of had this conversation on stage yesterday with Pisani moderating the panel, and where are we with the S&P? So at 20 times earnings, forward earnings are at a 5% earnings yield, which is what we often talk about as sort of the real return indicator. So maybe it's a 7 to 8% nominal return. This is a Siegel, classic Jeremy Siegel, how do I come up with return expectations for the S&P? So 7 to 8% for the S&P, or let's call it the next 7 years. Then you look at the bond rates, all right, so the TIPS yield's at 2% long term. You got the cash rate at 5.5%, which is basically saying there's no way this 5.5% is going to stay here this long. But talk about the income levels you could get off of a income note, what it looks like. If you think about 7 to 8% as your S&P that has all the risk of an S&P 500, maybe talk through the dynamics of what an income note looks like and what's available. What are the different risk considerations when you build that type of income note?
Yeah, so again, they're going to vary daily, right? So we want to with all the the caveats that come along with it, we want to make sure that that we look at it. Actually, it's interesting. We just priced out. I mean, I think we're in the model, right? We're targeting, and this is more of a. Let's use an actual example, if that's okay, right? So, the income model that we're building out with Wisdom Tree, it's targeting about let's call it a 7 to 9% yield, right? So I think right now, based on the notes that we're pricing up, this is a diversified portfolio, equity portfolio. It's about 8.25 is the current yield there on that strategy.
And that's like a global allocation. It's like a 70-30 U.S. foreign mix. It sort of it recognizes the home country bias that everybody here has as globally minded. We think we are 60-40 is about where you would be on ACWI, but most people are not there in terms of their baseline. So it's built with that in mind. But 7 to 9% is interesting. Now, what are the trade-offs you get when you make that type of allocation?
So you're locking in that yield, right? So what you're doing in the income side, right, and we'll talk about the growth side in a moment, but in the income side, right, you're basically you're locking in that yield. So, right, you're giving up, right, the potential upside participation, right? There is no free lunch, right? You hear that all over the place. And so basically what you're doing is you're basically trading off the upside participation in those same equity underliers, right? For that income yield of 8.25%, right? So.
And when do you lose the coupon?
Yeah, so it varies, right? So you set a coupon protection level, right? So we'll see. Again, this will vary over time based on pricing, but typically, I think in terms of the model that we're building out, you're looking at protection levels on the coupon of 20%, right? So you keep that coupon until the underlier itself breaks through that 20% that 20% downside.
And sort of similar on the growth side. So you basically describe. So if you're going to keep a 7 to 9% coupon, as long as the underliers, whether it's S&P and Nasdaq, it's mid caps or EFA are emerging. How's the terms typically look on these customized equity baskets for growth notes?
Yeah, so you're seeing on the growth side. So again, like the difference there, right? So you're maintaining equity exposure on the growth side with some upside participation, and and you can really price that out any way you want. And so we're targeting protection levels, and this is a pretty wide range from 10 to 50%. So all that means is that in the case of the note. If your note returns between 0 and, let's say, at a 20% protection level, 0 and negative 20%, at maturity, you're paid back your principal, right? So you're basically buffered, right, for that first 20%. If it breaks through that, in the case of hard protection, 21% down, you're only losing 1%, right? But we're pricing up these notes, right? It is a bond, right? So there's duration, right? So you're investing to maturity over that period of time. But you can have uncapped participation, right? And so you can actually get full participation in the upside. Obviously, there's the protection on the downside. What are you giving up, right? You're basically buying that bond, right?
This is where the complexity is. This hard and soft protection. There's different terms or different maturities.
There's a secondary market for it too.
There is a secondary market for sure, and the secondary market is getting better, right? So just to kind of lay it out, the issuing bank is required, right, to provide a daily mark, and so there is liquidity right now. We would say, if you're buying the note, you should buy it with the intention of holding that note to maturity. Right, that should be the case. However, just if market conditions dictate, and you do want to exit that note, you can sell it.
You can also scoop them up on the cheap, right?
You can, yeah, absolutely. And we're seeing more interest, quite frankly, in advisors or other asset managers in beginning to participate in that secondary
In times
market.
of stress, you can go shopping on some interesting stuff.
Absolutely.
Yeah.
Yep.
So at a minimum, people should check out the model center to be watching for those bids. So advisors can bid from other advisors selling notes?
You can. It's not a very mature market, I would say. Just again, full disclosures, right? The typical sale is the note back to the issuing bank. However, there is, we can connect, advisors with other, sources of liquidity in the market, right? I think there's work to do there, quite frankly, just to be, again, it's an industry that's growing, it's evolving quickly. I think there's definitely more access we can provide to those secondary markets, but it's there if you need it. So, you mentioned, the soft and hard protection, and again, there is a lot of complexity, and so the one thing I would just say is, and that's really, a driver in partnerships like the one with WisdomTree is start simple, right? Align with broad-based equity indexes. Focus on simple protection levels, simple protection inputs as well. But we could talk all day just around the various forms of note, whether it's payout, participation, protection, duration, all of the above.
So on SiriusXM, where we air live, we can take calls. I usually don't do calls for my show, but Guy Adami has started a call-in show on our channel, so they are taking calls all the time. But we here at the conference, Future Proof, you can do Slido. You have questions for JC, for Matt. You want to get involved in the conversation? Put up your questions here in Slido, or you could also just shout out your questions. But
the old-fashioned way. Remember we did that?
Yeah. We got a question in the audience.
Yes, JC, thanks for the shout out. But you were talking about the dollar, correlation or inverse correlation with equities. What about the 10-year? Any similar relationship with the dollar? Not important.
Just so I could repeat it for the audience listening here, the question of the correlation between the dollar and the 10-year. What do we think about that?
And the equities.
Yeah, for me, the implications of the moves in yields are more from a sector rotation perspective is really how I look at it. These rising yields will likely put pressure on growth and technology, like we saw last year, if yields are going to rise. And I think the dollar is more of the risk-off scenario, right? So, rising yields gives the market sort of a risk-off tilt because of the massive exposure that S&Ps have to growth. But I think the real flight to safety the market keeps proving is the dollar. It's not a coincidence that the day that the dollar bottomed was the day the new 52-week highs list peaked. That was 2 months ago.
There's a question from Yasser to JC. Do you see as much of a correlation between the dollar and other developed market equities? This is one of the topics I just had 2 seconds on. I mean, I've been along a proponent that you should separate out your currency decision from the stock market decision, that you don't have to be fully exposed to the euro when buying European stocks. You could hedge it. You actually get a carry trade on top of it. In Japan, your carry trade's 5-6%. And so you could say...
They should make an ETF for that.
They do have a few ETFs for that. But so you don't have to do that. So I'd say often, to JC's point, that the dollar is a sign for the S&P. You could say a weak yen is one of the best things ever for Japan. And often these countries become more competitive when their currencies are weakening. So I would definitely say you don't have to make that decision together.
Yeah, DXJ, this thing was making new all-time highs. The world looked like it was falling apart, and this ETF's making new all-time highs. Like this
Trading like an AI stock.
Right, exactly. So this is Japan, but price in local currency, and as the yen's gotten slaughtered, that this ETF is just killing it. It's up like 14 months in a row or something crazy, or like 13 for 14. It's insane. This thing is a beast. And again, with every day that passes, creative companies like Wisdom Tree are coming up with new vehicles to express a given thesis. In this particular case, it's rising Japanese stock prices that are making 30-something-year highs, and a weakening yen. You're getting both.
Maybe one of the bigger mistakes people have made over the last 5 years is if you look at the unhedged, which is like a $15 billion ETF, it's lagged by 20% a year for 3 years. It's amazing.
Not
amazing.
A Wisdom Tree ETF.
All right, question from the audience. Talk about structured outcome ETFs compared to notes.
Yeah, I think for the sake of time, I think the real at the core, right, is the perpetual nature of the ETF, right? And so you don't have a duration, right? And so you have those same, those protection layers, but they roll, right? And so, right, so with that, basically you're giving up, right, some of the ability to customize, whether it's duration or downside, right, protection within the two. And so at its simplest, right, think of the ETF as a perpetual instrument, as opposed to the note, which has a finite duration, right? And you can manage that. You can basically ladder the notes. That's what many advisors do, right? To create, again, a diversified portfolio of notes, whereby, again, because there's a lot of different buffers, right? So we're not going to have time to go into all of them, but ETF has a single objective, which is great, very important and appropriate. Single objective, perpetual in nature, and so relative to the note, which allows you to customize that. That exposure at a very detailed level.
Well, this has been a special live broadcast of Behind the Markets here from Future Proof. I'd like to thank our guests, JC Parets, All-Star Charts, Matt Radgowski from Halo. I'm Jeremy Schwartz. You can listen to us on our Behind the Markets podcast every week. Have a great week, everybody.
Thanks, guys.
Thank you, Jeremy.